wherever silver peaks out, say it peaks out at 68, somewhere in here. Well, I think it's going to go to around 72. I think that's kind of where it could blow up and kind of shoot higher to maybe into the 80s. Overall, silver's on fire. There's a natural pullback level around the 38% retracement to a 50% retracement. So we could see silver pull back to $50 or $43 an ounce. But then I think it's going to be stuck probably above the $50 mark. You know, we've been stuck under the $50 mark forever, which means it sparks more emotions, which means a lot of people are going to say this time is different, which every time it's different. We're still actually in a full-on rally mode, right? Like, I'm excited about higher pricing. And this phase right here was crazy FOMO phase. And I was telling everybody, I'm like, listen, we're about to see some sharp pullback because everybody is going nuts right here. Is it going to be the start of a bigger sell-off, bull market? Gold is like just trying to break through this kind of euphoric little peak that we had back over here. The chart is pointing to about $5,100, $5,200 per ounce. Silver's on fire today. It's up almost 5%. Big move. Silver has already broken out of this pause right here. Gold is kind of stuck trying to break out, but silver's already extended. It's already moved to the upside. It's breaking out again. Our target on here was about 68 and change, which we're probably going to hit that in the next day or two. And then we can recalibrate what happens from that level. But overall, silver's on fire. And this is one of those other signs that's telling us we're a little bit later in the mature rally phase in precious metals. Is gold has moved up very nicely for many years. Now everyone is piling into miners, silver, platinum, and palladium. When we see the volumes pick up in all of those, and pretty much any stock that has the word mining in it, could be copper miners, could be base metal miners. This is usually what happens near the later edge. Later stages of a rally, they say, okay, forget the boring thing that's worked really well in the past, gold. Now I want to move into silver. I want to move into miners, things that move faster. And that's what we're seeing. And that's why we're seeing silver break out.
When silver suddenly outpaces gold, it's rarely about fundamentals. It's about crowd psychology kicking in late. This 5% surge isn't happening in isolation. It reflects a classic late cycle rotation, where investors abandon stability for speed. As Chris Vermeulen has noted repeatedly, volume chasing faster assets often signals a maturing rally, not an early one. Mining stocks broadly surging, regardless of metal exposure, tells you liquidity is chasing labels, not balance sheets. Historically, this behavior has appeared near prior cycle peaks, including 2011, when silver enthusiasm spiked just before volatility exploded. And next, Chris Vermeulen talks where disciplined investors either protect gains or learn expensive lessons.
But it's a tiny market. There's a bunch of people wanting to get in and take advantage of it, and they're all moving to the fastest moving metal or stock. And that's, you know, that's why silver is leading, I think, right now. And it's a good thing. I think silver's still going to rally. I think it could rally to 71, 72, maybe even into the $80 mark as it peaks out, probably with gold at roughly the same time. So that's what I'm looking for.
Do you have any idea of what that move upward could look like, as far as when gold pulls back, then it becomes the buying opportunity again? Because we see that in the 2008 timeframe, silver did the same thing before reaching a new high. Yeah.
So wherever silver tops out, we could grab a couple levels. So depending on how we want to go, if we take this kind of low right across this level here, and wherever silver peaks out, say it peaks out at 68, somewhere in here. Well, I think it's going to go to around 72. I think that's kind of where it could blow up and kind of shoot higher to maybe into the 80s, but let's just say 72.
Silver's small market size is precisely why upside targets expand so quickly and why risk compounds just as fast. When capital crowds into thin markets, price projections like $72 to $80 become mathematically plausible, not because demand is stable, but because supply is fragile. In 2008, silver surged alongside gold, then collapsed more than 60% while gold held relatively firm. Analysts often cite upside targets, but rarely emphasize liquidity exit risk. This setup favors traders with discipline, not passive buyers assuming a smooth climb. Next, Chris Vermeulen shows What matters isn't how high silver goes, it's how fast sentiment flips once momentum stalls.
There's a natural pullback level around the 38% retracement to a 50% retracement. So we could see silver pull back to $50 or $43 an ounce. It obviously would be a substantial pullback. If we take a look percentage-wise, that could be, a 30, 40% pullback. And that's pretty normal for a move. I mean, a 38% retracement is very conservative. It's actually a very bullish pullback. If you pull back to that level and then it starts to build a base and starts to move higher, that is a very strong symbol. If it moves to 50% pullback, it usually is going to struggle a little bit, take a lot longer to get back up to all-time highs. And if it pulls all the way down to the 618, a lot of damage is done, because based on the Fibonacci theory, if you come down to the 618, the first measured move target ends up being right at the previous high. So you end up putting in a bit of a double top. So I do think once, we've broken through that $50 mark, now we're going to see silver have a blow off top wherever it tops, in the 70s, in the 80s over the next month or two.
This is where technical optimism quietly hides real downside risk. A healthy 38% pullback sounds manageable, until investors realize that means silver dropping from the 70s back into the low 40s. Fibonacci retracements work because they reflect human behavior, not magic numbers, and history shows that silver frequently overshoots fear levels. In prior cycles, even bullish retracements erased months of gains in weeks. Long-term holders need to ask whether they are prepared psychologically and financially for that kind of drawdown. Next, Chris Vermeulen shows how the blow-off phase feels profitable, right up until it becomes violent.
But then I think it's going to be stuck probably above the $50 mark. We've been stuck under the $50 mark forever. When we go back and look at historical price action, you can see here we've been, let's rescale this, we've come up to that 50 mark, or close to the 50 mark a couple times. It's sold back. I think now we're going to be stuck above the 50 mark, above these previous highs, or above like the 44 level. So I think silver's hitting a new pocket of price to stay in and hold up.
Mm-hmm. So by nature of silver being more volatile than gold, so you mentioned gold potentially having a 30 to 40% pullback. Do you think silver's pullback could be more violent than the gold pullback?
I do. I mean, when you look at some of these other pullbacks, they're like 88%, depending where you want to grab them, 70%. So there's no doubt, like even in 2008, when the gold pulled back 34%, silver fell over 60%. It's just a really fast moving asset, right? It's more speculative. And in general, something that's more speculative is more volatile.
The assumption that silver will hold above $50 ignores its brutal historical behavior. Yes, silver has spent decades capped below that level, but when volatility hits, prior support zones often fail spectacularly. In 2008, silver lost nearly twice as much as gold. A reminder that leverage cuts both ways. Wall Street often markets silver as gold's aggressive cousin, without stressing that drawdowns of 60-70% are not rare. For portfolios, that difference isn't academic. It's survival math. Chris Vermeulen talks how this volatility gap is exactly where most investors underestimate risk.
Which means it sparks more emotions, which means, and this is the number one problem with traders and self-directed investors, is emotions get the better of them and they chase prices. They buy high and then they panic out as it sells off. They make difficult emotional decisions. And so it creates more volatility, bigger gains, bigger losses, these volatile assets. And so I do think eventually we could see a fairly big pullback. You could potentially come back all the way down to 27, which nobody wants to see, but that's what's happened, in the past many times.
This is where the real damage happens. Not in price charts, but in investor behavior. What he's describing is classic late-stage emotional volatility, where retail traders amplify moves by reacting instead of planning. Studies show the average self-directed investor underperforms markets by 4 to 6% annually due to emotional timing mistakes. Silver's history supports this. Sharp rallies followed by brutal reversals punish anyone chasing momentum. The uncomfortable truth is that volatility isn't a feature. It's a cost paid by undisciplined participants. Next, Chris Vermeulen explains why institutions quietly prepare long before the crowd realizes the risk.
A lot of people are going to say this time is different, which every time it's different. But definitely the central banks loading up is obviously a big concern that people know something that the general public may not, although we already know everything's corrupt and broken. So physical metals is a good store of value compared to fiat currencies. But there will be a bigger percentage pullback, probably nearly twice as much of gold. And the question is just where is the top and how does price play out over the next few months here?
Got it. Yeah. Thanks for sharing that. So are you offloading any silver at this point, or I know you stack the physical metal?
Yeah. So I'm getting ready to. I have Sprout on speed dial. So I'm not there yet. I have talked to them. I'm like, just make sure I have everything set up. So when I want to just, start to liquidate some of my physical metals, it's super easy, which it is. It's just a quick phone call. I haven't sold any yet. I'm waiting for the blow off move.
Central banks buying sounds reassuring until you realize they don't buy for the same reasons you do. Yes, central banks have added over 1,000 tons of gold annually since 2022, but that doesn't prevent violent interim drawdowns. As Chris Vermeulen often warns, institutional accumulation does not equal short-term price stability. The quiet preparation to liquidate, setting up exits before euphoria, is the part retail investors rarely hear. Smart money plans exits early, not emotionally at the top. Next, Chris Vermeulen reveals how sentiment, not fundamentals, triggers the real turning points.
We're still actually in a full-on rally mode, right? Like I'm excited about higher pricing. I want to see higher pricing. But when things when you cut the air with a knife with the sentiment, and if you say one little thing negative about precious metals, you get your head sliced off. We're not quite there yet anymore. Believe it or not, we actually had that scenario, right? We had that when gold and silver were trading right at this phase here, not that long ago. So we had gold hit our measured move target right here. And this phase right here was a crazy FOMO phase. And I was telling everybody, I'm like, listen, we're about to see some sharp pullback because everybody is going nuts right here. Everybody's piling in. It's the crowded trade. And if you say one little thing about metals, you're a dead man online, right? And so then we had that correction. And so now we're nowhere near it. The market has just cleansed itself. And now we need another big run, which is about an 19% run in gold, which is probably, who knows how high that is in silver.
This is a textbook description of sentiment cycles, and most investors miss it in real time. When criticism becomes socially unacceptable, markets are usually overheated, not healthy. The previous FOMO phase he references aligns with sentiment data from late 2023 when bullish gold exposure hit multi-year highs just before a correction. Market resets don't end bull trends. They reset participation. The key detail is that rallies require emotional cleansing before extending higher. Next, Chris Vermeulen explains why euphoria isn't bullish. It's a warning signal.
But we need to get back into this euphoric phase. And you and I have touched on this a few times in the past, the market participant emotions here. We got to get into a euphoric phase, and then it creates a sharp drop. And the question is, is it going to be the start of a bigger sell-off or a bull market? And so the euphoric phase, I have tools and indicators and ways to identify this. And when we see it, man, it is like, get ready, manage your positions because things turn around on a dime. Price can drop and collapse. But no, I'm not selling my silver yet. I'm still holding on to it. I'm still thinking we're going to make a lot more on it.
Yeah, I sold a little bit the other day. I was sitting on some good profits, and it's just like, why not take a little bit off the table,
Yeah. We're long silver with one of our strategies as a recent trade, and we got some good upside targets from here still. We've locked in some profits already as well on it, and now we're just letting it run, let the trend do the work, right?
I actually sold some of the physical metal and then I bought some call options, and so we'll see how that play out.
Nice.
Um,
I think that'll work out. Yeah.
so I'm like, hey, I could cash in on the physical metal, and then
Yeah.
potentially cash in a lot more on the options. So we'll see how it works.
Euphoria isn't the green light. It's the exit sign professionals watch most closely. Indicators designed to measure sentiment spikes, like the gold optics or Coty positioning, historically peak right before sharp reversals. The quiet contrast here is important. Public confidence stays high while professionals quietly hedge, trim, or rotate into options. Locking profits while letting it run is not bullish bravado. It's risk control. Retail investors are told to hold forever. Experienced traders manage exposure dynamically. And what follows is where positioning, not prediction, determines who keeps their gains.
Yeah, gold is like just trying to break through this kind of euphoric little peak that we had back over here. The chart is pointing to about $5,100, $5,200 per ounce. So if we were to just forecast that forward here, you can see we've got a pretty nice move to $5,100 and about $75. Percentage wise, from where gold is right now, it's about 18.5% to the upside. So it's really exciting. This is a very strong chart pattern. If we zoom out on gold and kind of look at, all these patterns it's made over the last little while, it rallies, it has a pause, it rallies. It's just a series of these bull flags and pauses, and we're having another pause right now. And we had a beautiful play with this breakout and this move, and we might be looking to a whole lot of physical metals for longer term, but there might be another breakout trade here for about another 15% rally or so in gold, just as a short-term trade, just to pull more money out of the market, take advantage of this, and put a little more capital to work in this space. So I really like the precious metals space.
The excitement here isn't about gold rising, it's about how clean the structure looks when most assets are messy. An 18.5% projected upside to the $5,100 to $5,200 range sounds bold, but technically it aligns with repeated bull flag behavior seen since 2019. As technicians like Chris Vermeulen often stress, markets don't move in straight lines. They pause, reset, and then continue. The key risk investors miss is confusing a short-term breakout trade with a long-term allocation decision. Chasing upside without defining time horizon turns opportunity into exposure. Next, Chris Vermeulen explains why gold's reliability matters more than raw upside potential.
I like gold the most, just simply because I find it the most accurate. The triggers, the way it moves, I find is much more comfortable. You can put more money to work. Silver's a little bit more volatile. But again, the whole precious metal complex is on fire, and there's big potential upsides in everything right here.
Yeah, for sure. So I'm curious if you have any thoughts on obviously we had the big banks come out with their targets and such, and there being some allocation shifts regarding portfolio construction and adding gold to portfolios and such. Does that typically happen, at the new year, or when does that typically occur, or is it happening right now? Is there a way to even kind of measure that, or outside of price action?
Yeah, well, I generally, when there's big moves, big changes in sentiment, like the banks now saying and advisors saying, "Oh, get gold." Usually, we're on the last stretch of that asset. They're usually the last to kind of get on board, the last people to try and push it. A lot of advisors don't really want to do much in gold because sometimes there aren't commissions or ways to earn money in it.
When banks start promoting gold loudly, history says the easy money is already behind us. Gold's lower volatility makes it scalable for institutions, but advisory enthusiasm often arrives late in the cycle. Bank allocation notes typically follow performance, not predicted. The same pattern seen in tech in late 2021. As Chris Vermeulen and others point out, incentives matter. Assets without recurring fees get ignored until clients demand exposure. For investors, this means headlines about new allocations may signal crowding, not conviction. Next, Chris Vermeulen lays out why timing matters more than belief in the metal itself.
But, you gotta just be aware. I think when everybody starts saying move into precious metals, it's usually kind of most of the move has already been done. I mean, just look at the chart of gold. If we were to just squish this down, gold has had a massive move for the last several years to the upside. And now people all of a sudden, want to get into gold now. I mean, it's great for a trade, but as a long-term investor, I think you're gonna have to weather a storm. I think we're gonna see some pretty big volatility over the next year or so in the markets. And I think gold could be back where it is now. It could actually be $1,000 lower than it is right now, looking forward 12 months. I think there's going to be that kind of volatility. But after that, I do think we're going to about 7,500, 7,400 in gold. That'll be the next upside target. But that means we have to go through a big rally and then a correction of some sort. And then, of course, it's going to go higher. So,
yeah, because I mean, if gold is doing well and let's say the rest of the market turns downward, then that becomes like the source of liquidity for many investors and such.
This is the part long-term investors struggle with. Believing in an asset doesn't eliminate drawdowns. Gold being $1,000 lower within 12 months sounds extreme. Yet gold fell over 30% between 2011 and 2013, while the long-term thesis stayed intact. Liquidity events matter. When equities sell off, profitable assets become funding sources. The mistake is assuming safe haven means price immunity. Strategic investors plan for volatility, not perfection. Next, Chris Vermeulen reframes today's cycle by comparing it to a period many investors misremember.
Yeah, so like here I have a monthly chart of gold, and we have the first super cycle here, or one super cycle here, where gold went into a multi-year pause and everything took off during the blue box over here in early 2000s. Everybody moved into real estate and stocks, and then gold shot higher and took off. Now it looks dwarfed because we've got these high targets, but gold pulled back 34%. It sold off with the equities market and with the economy, and then we went into a multi-year rally. And so when we fast forward to the new super cycle that started in 2019, we saw gold move sideways for several years. Everybody moved into stocks and real estate. Now gold has become that shining warning sign that, hey, it's money's flowing here. I do think gold is going to push up to around 51, 5,200. And then I think we're going to see the music stop. I think we're going to see difficult economic data come out. We're going to see the stock market sell off. I think we'll see gold pull back very similar. I think we could see it pull back 25, 35%, which brings it back to around $3,400 an ounce.
Super cycles don't eliminate corrections. They disguise them as opportunities. The 34% gold drawdown in the early 2000s didn't kill the bull market, but it tested conviction brutally. Today's 2019 present cycle shows similar behavior. Capital chased equities first, gold lagged, and then suddenly reasserted itself. A projected 25-35% pullback would shock late entrants, not prepared investors. Macro stress usually reveals itself after price peaks, not before. Next, Chris Vermeulen explains why human behavior hasn't changed, even if the headlines have.
And then from there, I think we'll see the next target after that will be somewhere around $7,500 per ounce. That's the first target, but it could go a whole lot higher after that target, obviously. But I think we're coming into a similar price action as 2007, 2008. We're seeing money and sentiment moving into all of the assets in the precious metal space in a similar way. Now, it's different data and different news, but price always does the same thing. It goes up or it goes down. They're either people are greedy and they want to make money, or they're scared and they're selling.
The numbers change, but the psychology never does, and that's the real signal. Comparisons to 2007, 2008 aren't about identical triggers, but identical reactions to uncertainty. Sentiment-driven inflows often peak right before volatility accelerates, not after safety is achieved. Markets don't move on news. They move on positioning and emotion. Investors who anchor to targets without respecting cycles usually become liquidity for those who planned ahead.